Hey everyone, it's Alex Black with Mogul, CEO and co-founder here. Joey's having a little bit of technical difficulty. His new laptop camera will not allow him in. So as a tech company, we face technical difficulties. And honestly, we were going to start off today anyway with a brief overview of what is going on in the market. Obviously, we send out a weekly newsletter. However, this week we felt it would be keen to discuss Jerome Powell's remarks at the Jackson Hole Summit last Friday in person. And so, welcome to the webinar. Obviously, if you do have any questions along the way, feel free to drop them in the chat. And as we mentioned earlier in the email out to everyone, we will be having a surprise. And so, with that, we can jump right into what's going on with Jerome Powell. So, obviously, he's been in the news a tremendous amount lately because of what has been going on with Trump saying that he wants to fire Powell. Obviously, there are some speculation that can actually happen. And so, with his term ending, I believe it's next May, there was a lot of speculation going into this last meeting on what Powell would say. And so, everyone monitors Powell and what he says because he's obviously the chairman of the Fed. And as a result, he has direct say along with his constituents over the interest rates. And so cutting interest rates obviously leads to cheaper costs of borrowing. And for individuals, that means there's a lot more liquidity in the market. And as such, people are willing to spend capital a little bit more freely. That typically leads a little bit to inflation. And on the back end of that, too, as real estate investors, we care about that because that leads to home price increases. And the reason being, obviously, because if your borrowing costs are going down, you can afford a much higher priced house and you're willing to pay up a little bit more, especially if you're taking on a mortgage for that individual property. And so that's why we care about interest rates. Now, the market as a whole obviously cares about interest rates because when they're looking to spend, the different corporations that are looking to borrow money, then they'll have more capital to be able to use towards strategic initiatives that will then ultimately grow out their company. And so everyone had their eyes on Powell last Friday as to whether or not he would have an interest rate hike. Now, Powell has said in multiple meetings before that there are two reasons that he would cut an interest rate. And the number one, inflation returning back to the 2% mark. And number two, the labor market actually softening. And while inflation has actually risen a little bit, and I'll get into that in a second, the second part about the labor market softening, we do see that a little bit, and that's because both supply and demand are dwindling a little bit as it relates to jobs in the US. And as such, Powell used that as a nice guise to go through and basically say that he would go through with a potential interest rate cut in the September session. Now, this goes against what contradictory at the beginning of the year when people thought there would be multiple interest rate cuts throughout the year. And so the idea is that he might have foreshadowed that he has a second interest rate cut on the horizon. And this, of course, directly relates to everything that goes on. This directly relates to obviously everything that is going on with inflation and the job market. And so job market softening, Powell wants to cut interest rates, leads to cheaper cost of borrowing, leads to a lot more capital in the system, and that could lead to inflation hikes. Now, the second one being on the inflation component, the idea behind obviously that 2% number. And so that's healthy inflation. You like healthy inflation, especially as it relates to the economy, because it adds a little bit of increase to obviously the prices of everything. And it means that the economy is actually stimulating over time. And so when you think about the inflation rate going back to the 2%, that's that healthy margin for the Fed to consider cutting interest rates. Now, inflation's gone up. There's another point to make in the inflation argument because tariffs. Obviously, at the beginning of the year, there was a will they or won't they relationships between Trump and tariffs. And now, as we've seen a number of different trade deals be established with a number of different nations, we're getting a little bit more surefire picture around what those tariffs could look like and the implications that it would have on inflation. Long story short, inflation definitely will go up, and we are going to see an impact in the near term on inflation. However, Powell argues that because the job market is softening so much, then that means as a whole, we can consider cutting interest rates, at least in the September session. And a lot of experts are betting that they will cut even maybe one more time before year end. And so that's high level. on inflation. Obviously, feel free to leave any questions in the chat as we go through. As I mentioned earlier, Joey is going through a bit of technical difficulties, so I'm kind of going through the initial spiel. He's watching in the room. Joey, do you want to join the actual chat? Or you can leave a chat. There we go.
Here we are. Here we are. Just give me another minute or two so I can get my face on camera as well. But incredible opening statements there.
Yeah, I mean, so that's obviously what's going on with Powell. We add a little bit more there. There we go, Dylan. I completely agree. I was also sweating bullets over here. It's also a hot box in my office that I'm dealing with right now because I'm in South Carolina. So if you do see the sweat, it's because I just turned on the AC here. And there it is. All right, sweet. We're good. So hopefully that'll cool me off a little bit. So, Joey, one of the questions I wanted to ask you is obviously as we're pricing out debt for the different mortgages that we're looking to take out on the properties, what have you been seeing in pricing following the remarks of Jay Powell at Jackson Hole?
Oh, yeah, JP. So obviously there's been a lot of outward verbalization and I think you might have sort of already covered this, that rates are going to come down at least a quarter point. They haven't happened formally yet, but there's already been a lot of pricing speculation around it. We're seeing pretty significant changes in yields, and lenders are already offering floors at least 25 bips below where we were seeing before. So normally we're operating right now kind of at 6 3/4, which is really healthy because, when you have NOI yields on the properties of 7% plus, that yield becomes accretive to that debt, right? Which means it's more valuable to have the debt in place than to not have the debt in place. The definition of good debt. So as we're seeing that rate floor come down, that spread between the property yields and the rate floors that we're operating at will only serve to increase your monthly dividends ultimately. And that's what we want to go for, is that cash on cash yield, right? And that's completely contingent upon that debt financing. So we're already seeing pricing come down. It's great to see that even with speculation, we can see pretty significant swings in the right direction. And not only that, I think it will definitely help to bolster the market just from a macro perspective in terms of demand, both on the buy side and rent side. We've already seen pretty significant spikes in growth through a pretty tumultuous rate environment over the past 4, call it, years. But it's only a good thing for kind of the real estate market for now.
No, I completely agree. And yeah, just was curious what's going on because as many of the chat members might know from our previous webinars, as we were going through interest rate hikes and interest rate cuts, mortgage rates are not directly dependent on the interest rate cut or hikes. And there's this irrational exuberance that occurs in the market when there's positive and optimism in the market that ultimately drives interest rates down even prior to Jerome Powell announcing that potential interest rate cut in September. And so it's good that we're seeing a little bit of price fluctuation down. That means there wasn't a tremendous amount of irrational exuberance. And so that is going to directly correlate with returns. Interest rates down, again, just high level to synthesize everything that we went through. Interest rates down, home prices up, yields up, interest rates down, market good. And so that's high level there. And obviously, feel free to leave any questions in the chat. We will get to any question about the platform, especially as we go through that surprise later on. We're going to go through properties. We're going to go through a lot. We might even see Joey's face today. I swear to God, it's not just me here. He's not a bot. I swear to God. I did actually message that to someone today that that actually did happen. In the crisp chat, it is real individuals on the other end of that crisp chat. And I got in an argument with someone on Friday where basically he asked me if I was a bot and to prove that I wasn't a bot. And so I cursed, like, why would a bot curse? And then he said that didn't prove anything. So I will respond that was me responding at 9 p.m. on Friday night about whether or not I was a bot. So that is that it might be a little bit slower, but it'll be a whole lot more accurate with the responses in the crisp chat. Now, one other thing that I did want to touch on incredibly at trickbill.com bought in to give me a cookie recipe today. Fun times. That is brilliant. I don't think you could trick us into giving a cookie recipe because I personally don't know any of them. I don't know if Joey does, but hopefully you will never get tricked into. I could give you a veal parm recipe. I know that. That's pretty easy. I can't give anything else. All right, so I did want to briefly touch on, obviously, and keep in mind, if you do have any questions, feel free to leave them in the chat. I did want to briefly touch on everything that's been going on in the news around Yield Street. And so if you follow me on LinkedIn, you might have seen that I didn't. It's another case of a very bad actor in the real estate industry. And I'm saying I poor video. And Joey's gone. All right. So we'll go through a little bit high level on the, and I am glitching. Can everyone hear me? All right. Is that good now?
Oh, hey, and there we go. Right as you
There we go.
I'm back as well.
All right.
We're back on track.
Perfect. Your hair looks great. I'm glad you did it up so nicely.
It is
for this.
the longest it's been in a while, and I have a haircut scheduled for Thursday. I just want to let everyone know.
All right, good. Yeah, because I actually have a dentist appointment fixed for the first time in a little bit of time. Schrodinger's cat, whether or not I have a cavity or not. It's been a few years. Anyway, jumping into the yield street, I want to touch on this super high level. Basically, what happened was another bad actor happened in the industry. Fractional real estate investing being so nascent, you're going to have a lot of players that jump in the space and try and sell you novelty or snake oil in the form of stability. And so real estate investments on a whole act like a perfect mix between fixed income and equities, meaning on the fixed income side, you're getting dividend paid out. And on the equity side, you get equity upside in the appreciation of the asset. And so a lot of these different platforms out there have come to the market and sold this promise of that exact perfect blend of high returning asset with low risk attached to it. However, a lot of these platforms actually don't do any diligence into the underlying asset. And so what happened at Yield Street was basically they allowed for a number of different developers. They kind of just got subpar assets, number one. They were working with sponsors like Adam Newman's family office, which is kind of crazy. I mean, to trust them again, we did get a chance to look at those deals at Goldman, and I will attest to the fact that during the property pipeline overview, everyone was dying of laughter when they said we've got an Adam Newman project, and everyone's like, that guy's still relevant right now. Like, anyway, so we did say no to that project. Anyway, so Yield Street went forward with the project. They trusted sponsors. They didn't do their diligence, and as such, they listed on their platform, hoping that individual investors would do their diligence. But of course, real estate investment being very hard to attain, they were basically trusting Yield Street to have done the diligence, which led to a tremendous amount of losses. We're talking $340 million of investor losses at Yield Street. It really comes down to the fact that we are nothing like Yield Street, and we try to be everything that Yield Street is not. VC sponsors actually came to us and said, why can't you be more like Yield Street? And we actually voiced and said, we want to be absolutely nowhere in the conversation near Yield Street because we're going to be the exact direct alternative to it. And the reason being, Joey and myself, we're actually the only platform started by two institutional investors first that vet thoroughly the properties, and we work with the property managers. We're vertically integrated in that supply side. And so we can actually work with not only the operators that are boots on the ground, but we also can work to diligence and vet the properties as we bring them on board. We're obviously radically transparent as it relates to the operations, giving you memos on a monthly basis as it relates to the dividends, and complete transparency into line item by line item underwriting. Third is the quality of assets. And so Yield Street really focused on commercial assets. And the reason that that is one of the stupidest things you could do as a platform is if you're going to the closing table and you have a buyer's interview with the seller, why would a seller who has offers from Goldman to buy their thing, or Carlyle to buy their thing, or Brookfield or Blackstone, whatever it might be, why would you go to a crowdfunded platform for a $200 million plus deal where execution risk is entirely high? And that's the reason is they weren't getting the quality of assets because of that competition. They were up against the Goldmans, the Blackstones, the BlackRock, whatever it might be. We at Mogul compete in a completely different pond, which means that we actually are the Blackstones in this pond. We're the ones that come into market. And even by buying 3 to 4 assets, people are starting to flock to us with deals, asking us if we would take it on their platform. And of course, as such, we vet and have basically our pick of the litter, and execution risk is actually de minimis and actually very high. Execution is very high with us. We'll go through with it as long as contingencies are in place, and as long as the entire asset is thoroughly vetted. And so, Joey, I didn't know if you want to touch anything. I know I went a little bit more in depth, but I'm very heated about the topic. I think it sucks when another platform out there is really good at marketing and sells billions of dollars of assets only to lose all of their money. I'm personally invested in every single deal. I'm the first or second check in. Joey and I kind of compete to that exact thing. How does your deal sourcing differ compared to Arrived, ARC7, or syndicators? Again, we are nothing like them. Really, it comes down. I mean, Joe, if you want to walk through how we're different than them, because yeah, again, ARC7 is averaging a 4% annual return right now. They just announced it over an email that I received. Anyway, go for it.
Yeah, I think your analysis is spot on. I think this is another case study of grow fast and kind of put quality to the side, right? It's like you said, quantity over quality. These platforms that are doing $100 million, raises and kind of all you can eat, just white label funds with no monthly updates are just looking for scale. Ultimately, they deploy the dollars, they make their fees, they get rich, and they move on, right? Once the dollars are sold and once their customers are in the door, their success isn't predicated upon the success of the real estate, especially when they're not providing transparency into the more midterm, kind of shorter term performance of these assets, right? Like we do on more monthly basis, for example, right? Like you won't see any platform out there giving monthly dividends. One of the reasons that we do that on top of the fact that it's also just incredible liquidity is because we care about transparency, right? And we're perfectly comfortable putting out the actual itemized monthly statements on the performance of the assets every single month, because we are averaging 10 to 12% a year in net cash on cash yields. And, we can segue into the monthly performance of the dividends, because I think that's a great topic that we need to cover as well. But just kind of tying a bow on, the yield tree conversation, a lot of these other platforms, their goal was to grow as fast as possible, make their fees, and who cares about the real estate? Who cares about the investors? They're successful, and ultimately, those founders are gonna walk away super rich, right? I mean, they made their dollar. They kind of executed on a marketing plan and a marketing scheme, and ultimately, that's not what we're about at all. We're real estate first. We spent the entire first 3 years building this thing in stealth, so that way we could get the product ready to actually unveil to our investors. And we're doing it in a way that is de minimis in terms of platform fees, because that is already factored into your net return. The platform itself is completely free to use.
Yeah, and so will the platform fees go down? I mean, we actually charge the lowest across the board. If you look at any SEC disclosure across the Arrive, the ARC7s of the world, then you're going to see pretty egregious fees hidden in plain sight, but are actually hidden in 100-page disclosures. And at the end of the day, really, we do charge the 5% platform fee up front, but that is the lowest. And when you think of it as amortized over a 5 to 7 year hold period, it's actually lower than any other platform or asset manager out there, because you're dealing with a 1% asset management. Obviously, you can take into account the IRR and the drag on that, but it's de minimis compared to an asset manager. We also don't take any promote structure fees on the back end. And two quick things that I do want to share that are pretty relevant, that every time I talk to a different investor, corporate investor, I show them this screen. This is Fundrise. Obviously, can you see the screen, Joe?
Yeah.
Fundrise, obviously one of our biggest competitors. They 4.1 for annualized returns since inception. I say it, and this actually, I don't know if it's going to get me in trouble or at all, but during our time at Goldman, if we did this and bragged about it or even advertised it, we would have been fired. Not to mention, I hope this doesn't show my personal email address, but who the hell cares? Again, can you see my screen? This is the monthly distribution again, and they're proud of it, a 4.4% annual return. This is inclusive of everything. We're doing much higher yields than that and much higher appreciation because of our sourcing capabilities. And so with that, I know we got a little bit heated. We'll get into how cost seg affect us as an investor, or does it? It does. We're working with accountants on basically how can we front load the depreciation. And so for anyone that's not familiar with cost seg, basically real estate, we like to joke that the IRS wrote the tax code to incentivize two things. Number one, procreation. Number two, home ownership. While we can't help you with the first, you can sure as help. We can sure as help you with the second. And so cost seg allows you to basically depreciate your asset in a much shorter tenure. And so depreciation is a paper loss or a ghost expense that doesn't impact your cash flow to your bank account. Think of it as a tax shield. How do the rich get richer? It's because they don't pay taxes. It's because they shield it with depreciation. And so cost seg basically allows you to have a bigger tax shield by front loading it up front. What about taxing for W-2 earners? Again, this is a K1, so it goes up against passive income. You have to be a basically real estate professional. You have to hit a certain threshold of hours in a year in order to qualify to have it against your W-2. But that's all to say that it does help you when you're yielding at 10 to 12% cash on cash from your real estate assets, but not inclusive of appreciation. You're getting that hopefully protected from the taxes. And then Dylan, one last thing before we jump in. We got way too sidetracked. We get way too heated about these platforms. It's fine. It's all good. We enjoy it. But I think you guys made a really good point about quality over quantity. We are all assuming this Fed rate cut works out and real estate continues to perform. If market conditions change the next few years, should we as investors in Mogul have cash ready to invest even more with you guys? How will you communicate any major turns in the market you guys are seeing? Love the platform. Thank you so much, Dylan. I will caveat that nothing we say can be deemed as investment advice. We are not a registered investment advisor. We obviously vet all the assets. We're investing in each of the assets. We're allowed to provide our target underwriting of the assets. However, what we can do is just state what we're thinking and how we're thinking about it is over the next few years, we do think that real estate is going to continue to outperform, especially in the different metropolitan areas that we're targeting, because we're looking at the basics in economics, supply versus demand. And in these target MSAs that we're going after, the demand is far outweighing the supply. And on the next 3 to 5 year horizon, you're going to see supply actually dwindling relative to the demand that's coming up. Not to mention more and more buyers are coming to the pool. They've been on the sidelines for quite some time. And so right now, with it being a soft housing market, we actually can come in and operate with incredible contingencies and incredible, not only incredible contingencies, but incredible dislocation on pricing. And so we can come in below market. What happens to property proceeds if sold after the hold period is over? Distributed to end investors. All net proceeds are distributed to you as the end investor, the appreciated amount. Of course, that goes back to you. We actually do not charge any sort of promote like structure on the back end. That goes to our fees. All right. So with that, so I think I was going to go over successes over the last few weeks. I think we've gone through a lot, but just high level. Since the beginning of June, or since the beginning of July, or like midway through July, we've had 5 new properties, 7 sellouts, a new market, and we've been operating like crazy across the different metropolitan areas. We're actually starting to ramp up the different properties across the board. And so with that, Joey, obviously, dividend. And keep in mind, we are going to have a surprise later on, and keep in mind, feel free to leave questions in the chat. But Joey, do you want to go through the dividend performance for the last week?
Yeah, absolutely. So, as we're looking to the income statements, again, we distribute dividends on a monthly basis. For those that are new and joining us, you won't really see any of the other platforms out there doing it. Not only does it provide you with incredible liquidity, but it also provides you with complete transparency into how your assets are performing. Obviously, it's a snapshot in time. Every asset is and should be analyzed on kind of its annual performance. There's always going to be super months where we have assets performing even close to 2%, which is completely unheard of in a month. And then there are months where assets will even perform close to nothing, and those averages will still maintain 10 to 12% a year. And that's ultimately the name of the game with real estate. However, we're very, very focused on providing you that transparency. So with that, we had another incredible month. Not only was it great for seasonality purposes for kind of a lot of our short-term rentals, but also a lot of the pad splits continue to pay out north of 1, even 1.5%. We had 2 properties at the 3 properties actually at the 1.5% plus mark, which is an all-time record. And then we actually had about 6 or 7 additional properties kind of in the 80 bips to 1% range for the month, which is incredible. And then the rest of them are performing, relatively in line with underwriting, which will get you to about 30 to 50 bips on a monthly basis. And then that will get you to an annualized, about 5 to 6% just in income alone, right before factoring in appreciation.
So incredible month. You know, a lot of the properties again will have various forms of seasonality and operational efficiencies and deficiencies as they go through lease turnovers and releases. But overall, an incredible month of performance. You know, I think my blended performance for my portfolio was about 0.9% for the month, which is incredible. So as Alex said, you know, we're always the first to invest in our own properties. We're always the first to make sure that we are fully aligned with everyone in terms of you know, putting our money where our mouth is. And ultimately, it was a great month.
Yeah, so I obviously the 0.9% blended across. That means that technically speaking, that ARC 7, well, number one, both ARC 7 and Fundrise, you could hold an asset on our platform for 5 months and achieve the same return, actually more return than Fundrise or ARC 7 in a 5 month period than they would in an entire 12-month period. That is insane. Obviously, what we can talk about is the club's work and what the analysis tool was. If you do have any questions about dividend performance, any specific property, definitely feel free to leave it in the chat. I know we see a lot of different people coming in the chat, and we really appreciate you all coming out to these different webinars, because we're actually going to have to up our subscription now on the Livestorm app because of the fact that more and more people are coming to these webinars. So that's good stuff there. But one thing, is there any one particular asset that you wanted to call out, Joey? If not, we can potentially look into the surprise. I know we're obviously running behind on our anticipated initial agenda, but is there anything that you want to call out, or do you want to just jump right into the surprise?
Yeah, I do actually. You know, 3 of our pad splits, the Ratliff, the Victor, and the Ben, have been completely outperforming. Just a great signifier for the product that we're looking to launch in the pipeline, and continued focus on the pad split vertical. Also do want to note that the Roman has been just consistently about at that 1% level, which is crazy. And also just great fundamentals for Texas. I will hint that we do have another, what I like to call carbon copy of that asset in the near-term pipeline that's looking to materialize. So very, very excited about that. We love tried and true business plans. We love fundamentals that work. And, you know, shout out to our managers, obviously, who have incredible ears and boots on the ground, just to kind of, you know, keep our eyes and ears close to everything that's happening in every market, from, you know, like I said, zoning, you know, regulation wise, city ordinances, proper inspectors, you know, contractors, vendors, having all that infrastructure in place to make sure that, you know, at the end of the day, you are receiving that dividend. I know it may seem simple in the platform itself, but there's a lot of incredible people and a lot of incredible work that goes behind all those outcomes. So yeah, you know, just keep your eyes peeled for the pipeline, because we got some good stuff coming up.
Hell yeah. No, I get more and more excited by each meeting that we have discussing the actual pipeline. And then real quick, how are the Hugo and Gilmore performing? So we're actually closing on those 2 assets. I believe the Hugo we just closed on. Is that correct? Yeah, the Hugo we just closed on. And then the Gilmore is obviously closing on that a little bit later, as we just listed it on the platform. And so you can actually see in the what to expect on the property timeline, the closing date. We update those very frequently to make sure everyone is up to date on when to expect those first dividends. Real quick, can you touch on how the clubs work and what the analysis tool is? Clubs, community-led investment. Basically, think about joining a Facebook group, but being able to talk specifically about Mogul, real estate assets, how you're thinking about investing amongst a group of investors. But on top of that, there's extra incentives and extra rewards for sharing out Mogul as a platform. And so think of it as basically we give back. We cut those fees that you had mentioned earlier. We basically cut those fees by giving back to you all for helping to grow out the clubs. And so by inviting a friend, basically everyone benefits, and there's a kind of reward incentive that goes back in the form of 2% of every dollar invested. Feel free to go in the help center. We actually have a pretty in-depth overview on the clubs. If you invest, geez, we're getting a lot of questions. I'm going to leave them for the last, because I do want to get, it's 30 minutes in, and I do want to leave a lot of, well, one thing that we can touch on when we're on the topic of dividends is the Andres was 25% of that of June. Any reason why, Joey? There is obviously a great reason why that you and I went through earlier. If you just want to go through high level on that.
Yeah, sorry, can you specify that question super quick?
The Andres July dividend. So what we discussed earlier about how there was a tenant move out. And so obviously the Andres being a pad split, there was a tenant move out in the individual property. The tenant move out, while that doesn't necessarily attribute to a massive drop in demand, we use the top line gross rental income as the net payout from the actual pad split platform to us and then to you all. And because there was a tenant turnover, there are some upfront fees that actually get taken out prior to it, whether it be sort of, you can think of it as like a lease up fee. And so the same way that if you release in an apartment, you actually, basically any broker that helped you find the apartment gets a percentage back. Then technically speaking, like there is a release up fee, and it's a little bit larger than your traditional just kind of re-signing the same tenant over and over. So there was a 25% dip. So Joe, if you want to go into expected performance on the ongoing basis too.
Yeah, let me just double click on that really quick, because effectively, like what happens is, when you're talking about 6 to 8 bedrooms, every room actually in the home is also rented at a different rate, a different weekly rate, as it's called in the pad split world. And so, there are some rooms that are renting for $150 a week. There are some rooms that are renting for $250 a week. So from a top line GPR perspective, you're going to see some variability there. And then when you're talking about the bottom line dividend, right? So the great part is our performance is always, as has knock on wood, obviously always been above debt service. And that means that we're paying out the additional dividend above what the property makes on top of the debt service payment, right below the line after, obviously, the NOI after expenses. And so what I am trying to focus on is when you're talking about, a kind of 3,000 to 5,000 top line GPR for these properties, and then you're talking about, a 1,000 to 1,500 post debt service payout number. Even small swings in that can make a pretty significant difference in the actual payout percentage, right? So if you're talking about $1,000 dividend versus even a $500 dividend, $500 is actually literally probably like 2 weeks of one room. However, that will make, basically a 50 bip difference on a property of that size, right? So just kind of contextualizing that as to why that happens and why you see those bigger swings in the bottom line dividend numbers. It's really just percentages. And ultimately, as I mentioned, these are snapshots in time. So, we do have very, very healthy reserves and contingencies for all these properties. We have incredible property managers that are releasing these in under a week and under 2 weeks. And I will say also, pad split did change their policy recently to up their upfront fees and lower their ongoing fees for new tenant move-ins, right? Which would be worse for people with kind of lower average tenancies, but our average tenancies are 9 months plus for almost every property that we've launched. So, I will say that that's actually beneficial for us, because we would be paying less from a net perspective, even if we're paying that higher upfront fee, because our turnover is relatively lower. However, when you do have those turnovers, as will happen at every single property, you are going to see that small dip, that relatively small dip in GPR, and ultimately that dividend that could happen. But again, just focusing on obviously the 2-month average for the Andres, for example, you're getting above 2%, which is 1% per month. So incredible performances there, and we're right back on track at full 100% occupancy going into, going into the end of August already.
Well, great synopsis there. I do want to answer a few more of these questions. We can just rattle them off real quick, and then we can jump into the surprise performance, so to speak. If you invest in an Airbnb property, is there? And then also on the analysis tool, think of it as a tool that we built to provide you greater insight into the underwriting of the individual asset. You can actually enter any address, even outside of the properties that we have, and perform basically a back of the envelope paper underwriting, where we're plugged into real time data feeds that are giving you long-term and short-term rental data that you can use to vet your own properties that you're looking at outside of Mogul. If you invest in an Airbnb property, are there benefits to it or restrictions? As an investor, could you stay at the property, for example? Yeah, of course you can stay at the property, for example. And even if you message us, then we're obviously going to give you a much better deal because of the fact that we don't have to pay an Airbnb fee. So by all means, reach out to us if you see a property that you're like, I want to stay there. We're actually doing our corporate retreat we at one of the properties in the next little bit. Not to mention too, we practice what we preach. Our bonuses at Mogul are actually structured as payouts and investment into properties. And so we very much practice what we preach here. Incentive alignment couldn't be any better. How many months does a tenant need to be in place before they're profitable? Sounds like there are large fees there. Do you want to cover that briefly? It's on the Andres question.
Yeah. So definitely call me out if I'm wrong, but I believe the PATSWIP model right now is 10 days plus 8, which is 10 days plus 8% fee on transactions for a tenant moving in. So if you factor in, like, let's call it like 12 days, right? 10 to 12 days, let's call it like a third of a month. And you're talking about a $200 per room month, right? Or sorry, per week room rate. And then you're talking $800 per month. So, you take out a third of that, that's what, like $250-ish, right? A little bit higher than that. Really, you're recouping that cost in about another 2 weeks of operations. It's nothing that, would ultimately make the model unprofitable, whatever it is. But it definitely is a bit higher upfront than it used to be. Obviously, it's an opportunity for PadSplit to make a little bit more of a margin upfront for their retained stays, as there's more turnover going on the platform. It's more infrastructure costs for them to facilitate those turnovers, but ultimately incentivizes tenants and hosts to look for those longer retainer stays. They did also implement a really cool feature now, which is actually a review platform, just like they do on Airbnb. So every one of our properties actually has reviews now, and you can go and check them out. Aaron monitors them super close, works with every single one of the tenants. So far, we have 100% across the board. And it's going to be super beneficial because, again, it's all about that signaling and making sure that our tenants are happy. And we want that retainer to be super high. We want it to be 9 months plus. And then that way that, that upfront 10 days and 8% is completely de minimis.
Incredible answer. And then I'll fire through these last three because I think the second PadSplit tenants tend to stay 8 months or more. Thank you, Stephen, for that fact. Yeah, completely agree there. It speaks to volumes to what PadSplit has to offer there. Stephen, Alex and Joey, if the portfolio and investment increases to 100 properties, it is just the two of you. Are you adding people on team? As it seems everything depends on the two of you as a team. I love what you guys do, but I'm thinking 5 to 10 years like this. First of all, it's not just the two of us. That would be absolutely ludicrous. So we have 6 full-time employees. We're constantly actually adding new members of the team. We've been growing like crazy, which actually speaks to Jennifer's questions, which I can get to in a second. But not only are there 6 full-time employees at Mogul, but then there are teams on the property management side that help us. There are tax and accounting teams. There are a lot of other different functions that are outsourced, but we do obviously have, and they do a lot of the heavy lifting, so that way we can operate as efficiently as possible. So even in the event of just us 6, we can get to the 100 property mark, but obviously beyond that, we're looking to add more and more team members. So if you know of any very talented individuals, definitely reach out. We're obviously constantly looking at new individuals.
Yeah, and it's a great question too, because obviously like there is a ton of work that goes into it. And right now, actually, we're using this quarter as we launch new properties every week to focus on revamping all of our internal processes to make it so the flow for you guys, the flows for us are just completely streamlined and easy. So shout out to the entire team because that's been our entire focus this quarter, and everyone's working really, really hard to make sure your experience stays as smooth and easy as possible, even as we do get to 100 plus properties.
And obviously you get to see our smiling, grinning faces every third Tuesday or last Tuesday of the month. But obviously there is a tremendous team that goes into all of this, and all of which are just as equally, if not more, dedicated to us and obviously what we're building here and what you all have. And we are focused on making sure that this platform does not fall the way of the yield street. We're focused on our core principles, which is quality over everything. And if that means obviously some sort of growth has to be mitigated a little bit as we consolidate to grow, as we like to focus on in this quarter, then so be it. But at the same time, we are growing pretty rapidly even as we consolidate through these times. And so one of the things that I will mention is Jennifer mentioned that Drebin sold out while I was in the process of investing it. Why do you think that happened? Honestly, it's growth. The demand, thank God, it is growing as our properties continue to perform, as you all continue to spread the message. So thank you again. You are one of the strongest communities I've seen across any of these different platforms. So continue to spread the word. And as such, apologize if we didn't get to the last few questions, and we will in a second, but we did want to do the surprise like our to so we did have some likes of
And you did cut out a little bit there, Alex. I think your video shut off. Yeah, you were kind of cutting in and out there. I think your video's off, but I think you were commenting.
My video's off?
Yeah, your video's off, and I think your audio was cutting out. I don't know if that's happening.
Is it good now?
I can hear you. We can't see you. But
damn.
It's okay.
Anyway,
it's the first time that we've had these little kind of mishaps, and it happens every so often. It's all good.
Well, with that, obviously, we got the surprise that we've been waiting for. As someone who actually got kicked off the aux in their team workout room for the rowing team at Georgetown for playing I Knew You Were Trouble, we have a special drop named after the one and only who got engaged earlier today, a new property. And she's a shrewd businesswoman. She's an incredible pop star. She's obviously got engaged, so congratulations there. I don't think she'll ever hear this ever. But we do have a new property. Joey, if you want to show the Swift.
Boom. And your video came back right in time.
There you go. And so Thomas will be dropping in the chat. There we go.
Awesome. You guys can see this?
Oh, yeah.
Perfect. Yeah, so here we have the Swift. This one was sourced out in Glendale, Arizona, and has incredible fundamentals, relatively healthy property size. Let's actually focus really quick on the location. So, we always reach out to our property managers and always talk about kind of, again, boots on the ground, talk about, what's happening in the market, what's happening in terms of the path of growth. And right now, this area has been really, really great in terms of both in-migration fundamentals and also tourism. You go into kind of downtown Phoenix, downtown Scottsdale areas. Obviously, everyone knows those areas. Very kind of, central, main and main, almost what I would say saturated in terms of, what has been growth over the past 3 to 4 years. The Phoenix market overall is definitely improving a lot. And we have some incredible assets there that are a little bit more STR agnostic in terms of the pad splits that we have that are a little bit more centrally located and located along, again, more of those like, transitory arterial lines with, bus lines, transit, highways, etc. But anyway, super, super great location. Our property managers couldn't have spoken more highly about this. And ultimately, we can focus like we always do on the fundamentals, right? As you can see, it's a good looking property. I would definitely go on and check out the site, check out, the mural that's there. It's pretty cool. We will have Surge managing this one per usual. And we did end up getting all the furnishings to convey within the PSA, which is incredible. We actually are looking at rates kind of in that 6.5 interest only range now. I know that guidance just came out. And so when we underwrote this, it was still at 6 3/4. If we are able to achieve that 6.5, obviously this will be updated. But keep in mind, this underwriting is already factoring in that 6 3/4. So that can only be an improvement. This one had over 2 years of verified operating actuals with NOI yields that were very, very healthy, over 9% on the current basis. And then, per usual, you can go in and kind of check out some of the sales comps that would help justify today's basis and kind of where we see the growth going in the future, right? We always used to say, you don't want to just value things off of what they're worth today. You want to be able to take things that are sold nearby and actually factor in that growth for the future. So, you're seeing things like, the 55416 West Village that sold at 547 over our 515K basis. That's already what, 30-ish K of growth on a 515K basis. That's already healthy, factoring in over, 1 to 2 years of the go forward business plan day one. And that's before you're factoring in market wide growth. So I love to focus on that day one basis. You can go and see the rent comps, which we take directly from AirDNA, incredible, projection tool that they have now, and their comps tool has come a very, very long way. Our lenders actually use that to justify DSCR value, which is so wild to me when I first found that out, but obviously makes a ton of sense given it's the largest consolidation of STR data out there. You can go in, kind of test out your assumptions again, per usual, on your base bull and bear case scenarios, and you'll see kind of the pre-baked rental income expenses and appreciation, which you can then go into the analysis tab tool and actually configure yourself, which I can share next. This property right now, closing is scheduled for October, which means that the first dividends will be paid out in November, assuming operations in October. And again, this one's already coming pre-furnished, pre-operating, so there should not be any interruption in that transition period. Go down, see how the property's capitalized, purchase price, minus your 75% LTV debt, you get your day one equity, your capitalized costs on top of that, and then you get your total offering amount. So that's kind of how we're thinking about this in terms of the analysis, and would definitely leave it open for any questions.
Yeah, I mean, if you're fresh, I think we actually just got a pretty solid investment in there. There we go, 10K, pretty good right off the bat. And so obviously we do expect this one to move pretty quickly. Our club credits retroactive. If you mean investments made in the past, it's only investments made into the future, because obviously your investment will count towards the group total investment, and then dividends, or basically credits, will be paid out backwards. And also I did get a message about the piggy bank. The piggy bank is closed upon, just so everyone knows. And then the analysis tab is in the chat, but let's go to the analysis tab and have Joe walk through.
Yeah, happy to. Perfect. Let me know when you guys can see that. Are you able to see?
Oh yeah.
Awesome. Yeah, so as you can go to the analysis tool up here in the dashboard on the toolbar, and ultimately type in any address that you want to underwrite any property across the country. Incredible tool the team has built. Alex effectively automated what used to be a very manual Excel sheet that we used to use to underwrite all of our properties, like we did back in the investment banking days. But here we have a fully dynamic, fully automated model that you can actually go in and play around with yourself and effectively change all of the base bull case and bear case assumptions. So, you can go and see the comps. You go down here, you have your base bull and bear case assumptions. You can actually go in and edit those assumptions and have it change in real time, right? To be able to see what your yields will look like, your returns will look like, your profit, and your multiple on invested capital. And so you can go down and actually see the cash flows as it walks through year over year. If you want to get super granular about it, walk down the income statement, see how capital appreciation and growth is factored in, get to your unlevered and levered return, and ultimately see it across a 10-year hold, which is really, really great. So, I urge you to go in, stress test your own assumptions. But again, we're ultimately being conservative about our year one base case underwriting, making sure that's either under or in line with what we've already achieved from an NOI basis. And again, we're factoring in pre-fee income to post-fee income from the T12 performance, actually the T24 in this case, trailing 24-month performance. You can go down, play around with your income growth assumptions. Property taxes are relatively low in Arizona, which is great for us as owners. And then you have your insurance, your miscellaneous costs, which are kind of any and all operational costs around maintaining the property, your property management fees, and then your growth on those expense items. Then you have your appreciation, which is your capital growth, which is factored into growing that basis day one into what that back end sale price is going to be at the end of your term. So if you go up here, you can see the hold period. You can play around with it, see what happens if you were to sell it in 1 through 5 years, or 7 years, 10 years, all the way up to 30 years. Definitely urge you to kind of mess around and see how the IRR is affected by that. It's a great learning tool as well. You can see your capitalized costs here, your sources and uses. You can play around with it too, sensitize it. What happens if we do get that 80% LTV debt, right? Or we do get that 6.5% floor. Definitely check it out, see what happens. It's accretive. Like I said, it'll only improve the value. And then you can go through, mess around with some more of your financing assumptions, toggle refinance assumptions. And then ultimately this exit is driven off of that appreciation appreciation assumption up here, right here. And that's what will drive that back end value, also based off of that hold price, right? You could factor in your brokerage fees on the back end, your dispo costs, and then that's how you walk down to your cash flows. So definitely go check out this tool. It can help even the most seasoned investor become even more seasoned investor. It can help you out if you're just getting started into more complex real estate fundamentals and want to understand financial underwriting tools. Definitely check it out.
Love it. And also, if you did want to plug in the 80%, you can do it in the LTV, and it should update throughout the entire thing. So we built in that functionality. A few quick questions rattled off. Logged in late and see many of my questions were asked already. Can this be summarized and sent out? Yes, we send out the webinar recap and everything like that. So Thomas will be sending that out after. And if you refresh, I think we got another investment, which is great there. So if you refresh,
yeah, I can go back to sharing my other screen.
Yeah, well, it shows it here too.
Oh, does it?
Yeah, if you refresh it.
Oh, nice.
There we go. See, that's what I'm saying. That we
Very
made
cool.
it easy for you, Joey.
We think about everything. Yeah, that's great.
Yeah. And then have you considered Gilbert, Arizona? Actually, at Goldman, we looked at industrial parks there. I just looked it up and confirmed. Yeah, Dolphin was doing some grade A industrial out there. We looked out there for industrial. I don't know, Joey, what do you think about Gilbert for the single family rental asset class?
Yeah, I was just trying to look for a map. Yeah, we had looked at Gilbert a lot. We actually looked at some multifamily deals out there too. Good fundamentals. Like I didn't see anything wrong with the market. I think that, definitely in the path of growth. There was a lot of industrial activity, I remember, out there. Definitely a lot of slides on employment fundamentals for jobs that were going to be created along what was called the industrial corridor. But we're always open to investment. Again, if it's not in, downtown Phoenix, downtown Miami, downtown New York, where your fundamentals are going to ultimately be completely extinguished by just topped out market growth. Like we're always open to new opportunities. And again, we keep our ears super close to the ground. So if we were to expand into, the city of Gilbert, we would definitely be talking to our property managers really closely, understanding what's going on in terms of, again, city ordinance, trying to understand problems that have been happening in the market, getting to kind of your worst bear case scenarios. And that way we can be prepared.
Incredible. And also, if you refresh, I think we got one more. But outside of that, yeah, everything I feel like is named the industrial corridor. If there's some path, bingo.
Yeah.
There we go. More investment. So yeah, I mean it. Real quick on this, can we see the Swift on the website now, or will it be posted later? Thomas, do you want to send it in the chat again? So that's the special offer, obviously, with the Drebin selling out in under 48 hours. We are offering you all the ability to have even pre-sale to any sort of sale. So feel free to go in. It's that T Swift, and you can go in, check it out, and play around with it. We also sent the calculator. We'll send out, obviously, in the recap, the link to the T Swift. Why are you grinning, Joe? I feel like you have a shit-eating grin right now. I don't know.
Oh, I was thinking about the name T Swift.
Yeah, the naming question. Curious how you choose the names for your property. To be honest, it's split between investors that invest. If you want to name a property and want to invest at least minimum of 25K in a property, you can name that property. So Piggy Bank was named, Andres was named, all these different ones were named, and by individuals that were just like, we want to invest in the property. And then sometimes they pick movie characters, sometimes they pick other characters. Today we felt it respectful to pay homage to, I don't know if that's the correct pronunciation.
Homage.
Yeah, Joey got me on hibiscus the other day. It turns out that is the correct pronunciation. The spadoinkle.
We're getting crazy in here.
I mean, honestly, that might be coming out. I love that. That's the thing is, we flip on liquidity, these properties will be named like that forever. And so if you're just trading and one day you have Citadel being the market maker for us, and all of a sudden they're like, we're long on the spadoinkle, that would be electric. Love that. Can you see the Swift on the website? Obviously, you can check it out. With these strong double-digit IRRs, good MOIC, strong cash-on-cash returns, and of course, those are all the investment terms that are laid out there. I think you guys have mentioned in your emails these returns may not last. Do you think these returns are the new normal? Do you expect increased competition for the properties your team likes to drive returns potentially lower over time? I mean, Joey, if you have an opinion on that, I'm happy to hear. If you have an opinion on that, would be very curious your thoughts.
Yeah, our goal is to 100% maintain quality. You know, I would not sit here and say that the expectation should be that a property is paying out 1.5% every month. But ultimately, like those, when you have 1.5% paid out in a month, like again, you've already covered a significant portion of your business plan to track to 10% for the year, right? So like again, it's a snapshot in time. Like focus on the overall performance of the properties, but ultimately, yes, like that is the goal, is like we want to maintain this quality and we will maintain this quality. And you know, we have an incredible team inward. That's, you know, much shout out to Michael, who's already being a killer at sourcing new deals with me and with a lot of our vendors and partners, and fully vertically integrated property managers with brokerage capabilities. And then also again, the focus is to really just, you know, really hone in on your fundamentals, focus on the single family rental product, you know, make sure that your business plans are complementary to the current market, right? So if we have high APRs in the market, we're going to want to focus on high yielding properties, right? Like in the pass flip model and the STR model. You know, if those rates come down to 3-4%, we're going to be completely gung ho on targeting those 7 to 8%, you know, yielding NOI properties that are plug and play and extremely low risk with extremely low seasonality, right? So every business plan has its benefits and every business plan has its shortfalls and potential risks. But ultimately, you know, your portfolio construction and doing that in a sustainable manner and tracking it with the market is what's the best thing. It's not how can we get the most volume of real estate on the platform to sell. It's how can we do it in a way that actually maintains this quality while we have this transparency and kind of all eyes on us focus for this monthly dividend, which is great. You know, again, we welcome the scrutiny. If there is a property that performs lower than underwriting, sure, let's talk about it. Let's throw the questions out there. Let's get to the bottom of it, and then ultimately you'll see that pop back up in coming months or in historical months, and that will all contribute to that, you know, 8 to 12% annualized cash on cash yield pre-appreciation. Yeah, so I hope that kind of answers the question.
And then also zooming out real quick too, if you think about the entire investment industry, and especially within single family rentals, you can liken it to when Citadel or any of these different quant funds came in and basically were the first in their market. There was obviously larger spreads and there was larger arbitrage opportunities as markets were more and more inefficient in the early days. But as markets get more efficient, the arbitrage opportunities or the spread becomes a little bit lower. And so right now we are in the earliest innings possible of single family rental investing. And we are actually the earliest player that is doing it in the quality of asset that we're bringing to the platform today. And so if you think about it, it's really, I mean, we have at least a 20 to 30 year period before this type of industry and this type of buying is even mainstream in terms of just everyone doing it. And you're always going to have emotional sellers. So there's always going to be this, basically you can think about it as equities in the stock market. When you invested in the stock, it was always 80 to 90% institutional float. And as retail investors became more and more investor heavy in the stock market, that made up to, it's still only about 30 to 40% of the float out there in the stock market. But if you think about single family rentals, we have the exact opposite phenomena where all single family rentals are owned by retail investors, but really people that are buying their own homes. And so right now we're the first institution buying in this space. And so you can afford to get a lot better quality of assets and you can afford to get much stronger returns in this space because it's obviously going backwards instead of forwards in terms of the way that the equity stock market worked with institutions. And we're the only ones playing it. Outside of that, thank you for the focus on transparency and quality. It's great. Thanks for the car. And then Joey, did you have any other thing on that? Because I had a question.
Yeah, quickly. I mean, it's a buyer's market, like plain and simple. Like I'm very comfortable saying that. Like there are good deals to be had right now. Sellers are flooding the market. New homes cost more than, or existing homes cost more than new homes right now, which is bananas from a macro perspective. Obviously, that's not going to be the case in every single market with every single property, but it's a buyer's market. This is great for us as investors. It's going to be the time to make great deals happen. And then that way you see seller performance over the next 3-4 years, even as rates come down. that's a plus, right? That's going to be an opportunity to refinance for us. And you're talking about break evens of 2 to 3 years. So crush the business plans 2 to 3 years in properties today. We're already operating at the rate floor. That rate floor is coming down. Refinance when rates get down to 4% minus in the next few years, and continue to be buyers in a buyer's market. I mean, yeah, it's good. It's a great time to invest in real estate.
And then lastly, not related as much, but Daniel did mention the Spadoinkle. 10 points to whoever knows what movie that is from. If anyone knows the movie that that's from without Googling, Joey, if you do that, I am going to be so shocked. Do you know what it's from?
I feel like I like kind of remember a scene of it with like a guy in a hat. I don't remember the movie. Like I honestly don't remember. I think I was like a guy in like a hat singing like something. I don't know.
It was
What is it? What is it?
I had no idea. I Googled it on the side, Cannonball. Just upset that I don't know.
Cannonball?
But yeah, it's Matt Stone and so Trey Parker, one of the founders of South Park, created a movie. It looks like Cannonball, which is a musical, and it looks absolutely absurd. I mean, it's just I don't even know. Cannonball the musical or Cannonball.
Cannibal.
Cannon.
Yeah. Okay. I actually haven't seen it, but I've heard of it. And I've seen that clip before.
No, you haven't.
I have.
There's no way in hell.
I have. Spadoinkle Day.
All right. Actually, I've actually heard that. Yeah. No. Yeah. But
And he is wearing a hat. I'm looking it up now. He's on a horse. Right?
Antonio, great work. 10 for me. Just got an email in my inbox. The mortgage spread has dropped to a 3-year low. That's good news for home buyers and refinancers. Thank you, Dylan. We can end on that. Really appreciate everyone's time. Joey, do you have any last comments before we wrap up?
No, great conversation, great questions per usual. Yeah, I really appreciate everyone's time.
Really appreciate everyone's time. Hope everyone's enjoying that swag. If you didn't, reach out and we'll be more than happy to send it out. But really appreciate everyone's time. Feel free to check out the T-Swift because as you know, these properties are selling out quicker and quicker and they're only getting better in quality as we get more and more assets to the platform. So thank you everyone for joining. Join us next time. Reach out if you have any questions. Smash the subscribe button. I don't know. Like Joey, you're the YouTube sensation.
Smash and like that subscribe button.
Yeah, exactly. Yeah, exactly. So thank you everyone. Really appreciate your time. And Joey, thank you as always for the conversation.
Thank you, sir. Appreciate you.
Appreciate you too. Take care.
All right. Thanks everyone.
Bye.
Bye.